Welcome to my trading room, and we'll be focusing on the full trading psychology course. So today I'll be doing the introduction of everything. So usually what I'll be doing today is definition of terms. So you can understand the terminologies. There is nothing practical to do today. So if you have not like and subscribed to this channel, I'll advise you do so so that you can always get notifications for all the new models that will be published soon. For all the new models that we publish soon, like, subscribe, and click the notification buttons so you can always be notified as well. This is a private video and it's not for general public. That's why you can share it. And don't forget that my private mentorship class is ongoing, and those that want to be part of it can always be part of it. I can always be part of it. I'll advise you part of it. In the mentorship class, what you get is very high value. You have a one-on-one private session with me, plus a risk management course that can help you in your trading career. Please go to the description on the link and you can have access to it. You can have access to the private mentorship class, just a one-on-one session. So over here, we have the full trading course completely designed for you as a gateway to perfection. This is just my idea, and the full trading course is designed from my is designed from my experiences, what I've learned so far, and things that have been helping me through. So first, we are going to be looking at the basics of Forex. And in the basic of Forex, we have things like the terminology, the basics and the terminology. We have like PEEP. PEEP is a definition for price in percentage. That is the smallest price in the market is called PEEPs. So for example, like I was illustrating earlier, but not in this class, this is the price, and there was a change in price. So PEEP is price in percentage. So any smallest change in price is called PEEP. A smallest change in price. It doesn't need to be the whole number. A small change in price is called PEEP. So assuming that we have something like this, 1.32. Now, in Forex, this is called a pipette. The last number in the price is called a pipette. The second to the last is what is called pips. What is called pips. That's what is called pips. Like, it's called pips. I was taking for example, like we have this to be called seconds, and we have this to be called units. So this is not really valued. The pipette is not really valued. There's nothing we can do with it. There's nothing we can do with this pipette. So what we are only counting is just the pips, which I classify as units or seconds, So sometimes you may discover that price moved maybe something like this. Now this is one pips exactly. This is one pips. The second figure has changed, so it is one pip. So if it moves from 0 to 2, we know it's 2 pips. So then for the third to the last, probably if it's something like this, we know that that is complete 10 pips. So we can hear statement like I lost 10 pips today. That's meaning that his stop loss was 10 pips and it went against his direction and he got a 10 pips stop loss. Or it could be I had a profit of 10 pips. Maybe price went to his direction 10 points. So that's just the definition of PIP. So over here, we have leverage, the ability to control a large position in the market with relative small amount of capital. Assuming that in my own definition and in my own terms, I see I see leverage as a loan in form of, let me say, overdraft. Okay, I have $100 and I'm using a lot size of 0.20. I'm using a lot size of 0.20. In the lot size of 0.20 that I'm using, my leverage is to 1 to 100, and it does not permit me to trade this lot size. This is a lot size. It does not permit me to trade this lot size with this account balance. So I have to change my leverage. Like I have to borrow more money from the broker to be able to trade 0.20 using this account balance. So I might end up changing my leverage to 500. Some broker gives enough leverage as high as 1 to 2000. That's for examness. But my preferred leverage is always 1 to 500 or 400. So that's what leverage is. Leverage is in a layman's language is like using someone's money to trade in the places where you have insufficient funds. So what is margin now? Margin is the amount of money required to open or maintain a trading position. Imagine going to a supermarket and you wanted to buy a goods for 20,000. It exceeded your price, or you were with 25,000 naira, but you actually went to buy the goods for 15,000 and exceeded your price. At that point, when you enter the supermarket and it was maybe 22, you'll be skipping, you would be okay. That is called informal margin call. It is telling you that the money in your account is not enough, it's not sufficient, it's above your budget. That is not, that's when you see your meta 5, it begins to blink red. It begins to blink red, 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 red. It means that the money in your account is not enough, it's not sufficient for this position you are taking. And one of the ways of controlling those things is if you're using a high leverage at that point, you can reduce your leverage from, maybe if you were using 1 to 500, reduce it to 1 to 100. Just except that is the lowest leverage that is available or that you're using. That is when you are. So margin is the amount of money required to open a position. So margin and your account balance work and your hand, like I'm using $100 position, I'm using leverage of 1 to 100. So the margin for that particular is gonna be different. So if I increase the leverage to 1 to 500, the margin will also increase as well. So that's it. So we have spread the difference between the bid price and the ask price. The bid price, the price in which you want to buy something, and the ask price, the lowest price in which you want to sell something. So I was giving an illustration. I'll give. So assuming that I want to buy I want to buy gold and the price of buying gold is $1, and I want to sell gold, the price of selling gold is $5. Now the difference between 5 and 1 is 4. $4 is the spread, and not just the spread, is what the brokers are charging me to buy or to sell this particular gold. That is what is called spread. So anytime you want to deposit or trade with a broker, you have to check their spreads. You have to check their spreads. The reason you're checking their spread is that so that you can know which of the broker have a tight spread. Now this is what I mean by spread. Okay, this is a price. Assuming this is the ask price or this is the bid price, then we have something like this. Now the difference between these two is the spread. The difference between these two is the spread. Most of the charts here does not really give an exact picture of what the spread looks like. So when we move to model 2, when I'm recording on mobile, on my mobile phone, how to use the Meta 5 and the trading view, Okay, I'll record with the system how to use the trading view, and I'll record with the my mobile how to use the meta 5, because it's mostly the meta 5 you'll be using, not the trading view. So trading view mostly is just for analysis. It's just for analysis, just to know your analysis. Then you make your entries or whatever with, you make your entry or whatever with the MT5. So that does it for that. Then we move to lot size. Lot size, like I was saying here, lot size, as I was saying here, lot size is the amount of a currency pair you want to buy or sell. That's it. So we have nano lot size. In nano lot size, you see it mostly in synthetic, like volatility 75. Then we have mini lot size, we have micro lot size, and we have standard lot size. Standard lot size are things like, standard is $1. You see $1.00. That is standard lot size. We have mini lot size. Um we have nano lot size, and we have micro lot size. So under micro we have 0.01. Under mini we have 0.10. Then under nano we have 0.001. So that does it. That does it for that. Then we need stop loss order. Stop loss order is another you use to limit potential losses by automatically closing a trade at a predetermined price level that is against your entry. You understand that, against your trading target. So probably I entered the trade. I said, okay, let me go to the trading view. I entered the trade and I said, and I wanted it to go to a particular direction. Maybe I was buying a trade and it was selling. So I said, okay, if it gets to this position in a sell axis, it should exit. That's simple. That's very simple. So that's how a stop loss order is. Then we have a profits, a take profit order. In take profit order, take profit order is placed to automatically close a position at also a particular rate. Probably it was going in your direction and you were profiting. So you said, if it reaches this level, just lock my profit and get out of the trade. That is take profit order. Then we have base currency, the first currency in the first pair in a currency, or the first currency in a pair. We have quote currency, the last currency in a pair. So that's just it. So first, let me show you the stop loss and the take profit order on the trading view, what it looks like, and I'll explain it more from here. Okay, now this is what a stop loss order looks like. Now I was taking a long position from this range in hopes that it is going to be going straight to the upside. And then this red here, this red shaded area is a stop loss zone. So if it exceeds this particular zone where the cursor is pointing at, the trade will automatically exit. So this is my stop loss entry level here. Then this is my take profits level, my TP. Assuming I was entering a trade now. Mm, Assuming I was entering a trade now. to give you a how to show you what the stop loss and the take profit level look like, so you can get a better understanding using the trading view first, and we can move on to other platforms. Is what India speaking time. So at least I've been able to show you what a stop loss looks like. So in our next module, I'll be setting it live for you to see, so you can see what it looks like. So that's for the long position. That's buying. Like this is the long position. I'm buying. So what if it was a sell position? So that's long position is buying. So if I'm selling, this is gonna be that's short position. That's what trade. You can be sitting trading view, long position, short position. So I'm taking a short position. The green is downwards, the red. So this is my stop loss. Stop. You can here see it here. Stop at the stop loss level, and you can see a target and profit target. That's just it. So at least I've been able to show you what the TP and the TP and the SL looks like. So over here we have liquidity. Liquidity. Liquidity and volatility are almost the same. The liquidity and volatility are almost the same, but there's a difference. Like there's a little difference, which I'll explain in the next class. There's a little difference between liquidity and volatility. Both of them has to do with the price of or the speed of price. The speed of price during the news time, the market is always highly, very volatile. It runs at a very great speed. But there are pairs that are volatile that normally they are very dangerous to trade, like they are very risky to trade. A little movement you can lose. So that's just a shallow definition of liquidity and volatility. So what is fundamental analysis? Fundamental analysis that you make based on economic, social, and political factors that may affect the currency prices or the price of what you're trading. So we have um, economic analysis could be things like CBNs, central banks, resolution, maybe the CBN governor or a central bank governor is giving a speech of a country in a country. You understand? Those are things or policies that affect exchange rates, tariffs, all those stuff. They affect its trade balances. Those are economic situation. Then when it comes to social, things like holidays, bank holidays, campaigns, and things. Okay, that's under political. Then under political, federal government decision, elections, war, and the other things. They affect prices too. So technical analysis are analysis that you make based on price histories, of price. That is what you make. That is technical analysis. So now the yardstick for doing technical analysis come in different form. We have chart, we have candlestick patterns, we have in general is price action. So those are the things that really is used for technical analysis. Those are the things we use for technical. Those are the things we use for technical analysis to determine the next move of price. So these are just a few things, and there are also others that we can always look out for. So before we proceed, now how do you begin to trade first? Now I've been able to tell you the basics and the terminologies. Now how do you begin to trade? First you have to become knowledgeable about what you're doing. You're going into Forex first. you need to find someone that can take you through, at least open the door for you and give you a seat. That is the first thing you need to know. Then after that, you can move on to start making research on your own, knowing what works, creating a trading plan. They say the next thing is to create a broker account. Without broker, you can't trade. So first thing, you can create a broker account and maybe be using the demo for your practice. And when you're using a demo, it's always good that you know what you want to do. It's not for you to just go and be placing trade haphazardly using different lot size. No, you're doing a specific action over time to determine the profitability first and know if you can use that pattern to trade on your live account. That is why you use them. So you don't just use them one haphazardly. You just open an account today, you don't have a target, you don't have what you're doing. You could be setting up a demo account of $50 and say, okay, let me see how I can use this particular trading pattern to raise it to this amount if it's possible. Maybe you can check different trading patterns with a demo account and see which one works for you before moving on to deposit real life funds. Now, the next thing is to create a trading plan. Now, from the lectures we are going to be receiving, it's going to be possible that we are all going to have a definite trading plan that works for you. So, having an which entails that by this time you might have win over your psychology. You have your psychology and plan, and you know what to do. That's just it. So you need to have an edge. Your psychology will always give you an edge, so you find it. So now, create an emotional equilibrium. After understanding your psychology, you have to create a psychology plan to help you stable. That will bring you to my trading psychology class. That class is mainly for people that will become professionals in what they are doing. You want to reach to the highest phase of trading. You need to go through a psychology trading class by me. That's very important. And the link to the course is available on the description. Okay, we have done all this. So now the third part we are going to be talking about is trading techniques. This is a model one course, and this model I'm just introducing you to the terminologies and things you need to understand and know about. So trading techniques, we have scalp trades. Scalp trades are taken in minutes, a matter of minutes. You close it and you're out. Mostly scalp trades, you make your analysis and do your entries using the minutes time frame, 5 minutes and 2 minutes, 1 minute, depending on what you feel like using. And you can still use the seconds time frame if you're using trading view. If you're using trading view, you make your entries and you move on. That is scalp trade for you. It's not meant to be um placed over. It's not meant to be hold for a long time. It's just something you just enter and exist in few minutes. So what is day trading? Day trading, in day trading, you find a perfect position that you can hold maybe throughout the day or for some hours of the day and you exist. And also you need to have a specific session you day trade with. You can say the New York session, you can say the London session or the other thing. Now, this is just an introductory course. Now, there is what we call trading session in Forex. Trading sessions are like the time of the day a particular country or continent trade trade on. Like if you go to US, their trading floor opens 8 a.m. in the morning, like early in the morning, like in Nigeria here. 8 a.m. all the public offices are open. 4 o'clock all the banks, all the public offices are closed, including bank. That is the standard working hour for banks, and so generally that is the standard working hour. So if you go to place like now we have 8 major trading zones, which are the US, and we have the US, we have the New York, we have the London, we have the Asian, we have the Asian, that's four. We have the Tokyo. We have the Tokyo. I think that's five. I can't get hands on everything now. So in that five trading station that I've just mentioned, they have a part based on their Greenwich Mediterranean time, their GMT. They have a time they open their office hours and they have the time they close. So during that time, that is when the trading activities occur. So it's left for you to decide, should I trade the US session, should I trade the New York, should I trade the Asian and the Tokyo, or should I trade the London session? So that's your own decision to make. That's your own decision to make. And there's also what we call overlap session. Okay, it's the overlap session that actually makes it eight. We have the London and the US overlap session. We have the Asian and the London overlap session. Those two sessions are highly volatile. Like the prices of currency run at great speed. They're extremely volatile. It's volatile. So if you're trading a pair that is liquid, that is highly liquid like gold, US 30, at that particular period, it can give you a significant number of profit, and it can also give you a significant number of losses based on the volatility at that particular overlapping session. So that's day trading for you. So we have swing trading where you hold trade for 3 days, 2 days or more, or sometimes week, depending on how long you want to stay. So that's swing trade. Swing trade, you can make your analysis with the hour's time frame and the daily time frames, and you move on. And you can also make your entries using the 5 minute time frame for sniper entries. That's for the swing trading. Position tradings are trades that are carried on for a long period of time. It could be 1 hour, it could be it could be 1 month, it could be 2 months, it could be as long as you can. But position trading is a long term trading. So what are the types of charts that are used? We have bar chart, and we have candlestick chart. So this is a candlestick chart, and candlestick chart is the best kind of chart anyone can use in trading. Candlestick chart is the best. So candlestick chart is the best kind of chart you can use. So after candlestick chart, we have the bar chart. Bar chart is not acceptable. I don't use it, so I'm just showing you so that you can see. We have line chart. Then if you're using a trading view, there are a lot of charts here that you can use, but I'm not interested in this because this is not what we are looking for. There are a lot of charts. So what we are actually interested in is candlestick pattern. This is what we use, and this is what we will always use, and this is what we always use. So now we have the questions: are forex markets regulated? Yes, they are not regulated. All brokers are regulated. So any brokers you want to use, make sure you know which country is regulating their trading activities. Now the country in which they are registered in is the country that will regulate what they do. And there are strict countries that they have strict rules when it comes to forex trading because of manipulation. So if you're trading with brokers in the US, you're more safe because they regulate the forex industry extremely well to avoid exploitation. To avoid exploitation. So forex market in US is also very regulated. You can also try other countries and not very regulated, including prop firms in that country. There was a time that we had the Prophet saga, and the Prophet saga came from the point that there were a lot of manipulations and things that the prop firms were engaging in that was making traders lose money. So the regulatory commission in US had to take it that they had to shut down most of the prop firms. So forex market is really regulated, and your funds are always safe. Now, what are the factors that aid volatility? Like I said, time frames, overlap session, economic calendar. Like in the case when Israel and Pakistan had a war, there was a significant change in price of gold. Gold have been rallying on the buy side since. Those are factors that affect volatility, economic factors, and the rest of others. What kind of currencies can I trade on? As a starter, it's always better that you trade the USD pairs. So now understanding setups, we have absorption, we have support resistance. Now this is the support is the support is the the down part of the, let me say, when one or two candles come together in the down part, they form a support. where one or two candles, like something like this is a support, something like this place is a support, this place is a support. I can't mark everything up here, but this is a support. Places like this are support. They are support. They are all support zones. They are all support zones. So the idea behind it is that when price gets to a part, like if price gets to this level again from here, if price gets to this level, I'll be looking for a buy signal because it has reached a support zone. A support zone. So when price reaches this place two or three times, it means that it's a very strong support zone. Then I should be considering taking trades from this level. Same thing, this is a resistance zone. This is a resistance zone. Two candles have met here. This is a resistance zone. Two candles have met here. This is a resistance zone. Two candles have met here. This is a resistance zone. Two candles have met here. When two or more candles meet at the high side, at the top side, topmost side of, at the top of the chart, it means that's a resistance. At the lower part of the chart, it means that's a support. That's what you should know about that. Then we have chart patterns. Chart patterns like probably we have something like cup and handle, we have double top, we have double bottoms, we have things like that. Those are chart patterns. Chart patterns are shapes that we have, that shape that forms in the chart, like triangles. We have triangles, we have um triangles, we have different shapes they form in the chart. We have rising wedge, we have falling wedge. Those are chart patterns. So what are chart fees is trends. Trends when a particular currency is going in a one direction over time, is going in a one direction over time. That is trend. That is trend. I haven't seen a perfect trend here. I would have liked to make a representation of it. I think something like this is a trend. Price have been moving upwards over time. Price have been moving upwards over time, and what I just drew now is called trend line. Is trend line. So if price break out from the trend line, they break out of the trend line. So I am anticipating price will be falling. Price broke out from the trend line, and this is range. This is a ranging market. Is what I call consolidation sometimes, depending on the time frame. But for now, this is a ranging market. I don't think I discussed about that. So we have correction. Things like this are correction. Things like this are correction. Price is moving upward, but you're seeing a sell momentum here. It is correction. Price is trying to gather momentum to go upward. So this is corrections. These are corrections. Price is moving forward, move upwards, but these are corrections. These are corrections. This is what you should take note of when you're going on a trend, when you're riding a trend. Always notice when price falls back. When price falls back, find entries towards the trend. When price fall back, find entries towards it. We have consolidation, which I've shown you here. So to me, price is just consolidating because it has been moving in one direction. So this is a perfect example of consolidation here. This is a perfect example of consolidation. This is a perfect example of consolidation. That's a perfect example of consolidation. So we have that, and we have breakouts. Breakout is when price have leave a consolidated area that it has been ranging on for a long time. So assuming this is assuming that how am I saying, okay, now this is a perfect view, this is a perfect diagram for breakouts. So price has been ranging towards this direction, has been consolidating in this particular box for a long time. Then it broke out of this level. The breaking out of this level is called breakout. Breakout. That is what is called breakout. So that's breakout. So we have trend reversal when price have been moving in one direction for over a long time, like we can see here. Then we now have trend reversal. So actually, what we are expecting at this point is the reversal of this particular pair. So that's what we are looking at, reversal of this particular pair. So reversal is when price have been moving in one direction over time and decide to go back. So now, before I come to this, I'll first take you to the anatomy of a candlestick. So we have the wick, we have the bullish candle, and the bearish candle. Now, in the bullish candle is the opposite of a bearish candlestick, and the body, we have the body. We have the high of the day. The high of the day is the highest place where price have reached, and the closing price is the point where price closed at for the day or for the hour or for the week. Then we have opening price, the price in which price started with this particular price for the day, and the low means the lowest point price reached for the day. Now the body signifies the strength of the body signifies the strength of the particular trend that is going, or particular direction. That is what it signifies. So here, over here, this is what I'm gonna be saying. So now the bullish is the opposite of the bearish. So you can see that there is a difference in everything. First, you can see that the closing price have changed, the opening price have changed, the close of the day and the high of the day has changed, but it's still the same thing. So now, so now the body of every candlestick signifies the strength. The strength of the body, or the height of the body, signifies how strong the trend is. So if we are seeing very bullish here, we are seeing less bullish here, and we are seeing neutral. So if we have such kind of a candlestick, it means that the bullish trend is strong. And if we have such kind of a bearish candlestick, it means that the selling is strong. So it keeps diminishing. And once it's diminishing, it means that it's time for a change of direction. Things like this is a hammer, this is a hammer. A hammer signifies a reversal to the opposite direction. So when you see price reducing itself and closing this way, it has to close before you define it. A candlestick must close before you can define what the candlestick is telling you. If it does not close, you cannot define it. Don't define a candlestick when you feel counting. So next, we move to the trading plan. A trading plan is a set of objectives you place so you can be trading it. So we have skills assessment are one of the things you look at. How strong am I in trading? Your skills are important when your skills are important when putting your skills are important when setting your trading plan. You have to know what you're good at and what you're not good at. Maybe probably you're good at USD trading gold. You know that's what your trading plan will all be about. You're good at trading GBP/USD. You know that's what your trading plan will all be about. That's just skills. Know what you're good at. Mental preparation. Your psychology must be in place. You have to do psychological checks. Now, your set risk level. Know what you're about. Know what you can lose. Know what you can afford to lose. Then set goals. Know your trading goals. Have trading goals and make sure that your trading goals are adjustable based on the market is showing you. Now, always do your homework, prepare for the trade, set exit rules. Like it could be, if I lose 20 pips or $20 today, I'm exiting the trade. Or if I have two loss in a row, I'm going to exit this trade. And entry criteria, like your entry criteria are just like your trading plan. It could be different things, it could be different things. We are coming to that. But for now, make sure you have an entry criteria, then you analyze the performance. So that is all for this course. This is just an opening segment to what we are going to be doing. So the next course I'm going to be doing, I'm going to be telling you about the natural trader environment, and I'll be showing you the stop loss, everything, the pips, the leverage, and whatever you need to know. And I'll also be showing you what each buttons mean in the MetaTrader. Same thing with trading view. This is for the new people that are starting Forex new. Probably you're new to Forex, you didn't know anything about it. At least this is going to open your eyes to know different things. You can, if you already know how to use the metaphor, you can start placing random trades so you can have a knowledge of what I talk about, or what I'm talking about, stop loss level, TPs, and the rest of other. Make sure that your MetaTrader is downloaded, your trading view is downloaded too, your trading view on your laptop, your MetaTrader on your phone. You can also download trading view on your phone, but I don't use it. I use my laptop. I use my trading view in my laptop for analysis, and I make my entries with my phone. So that is what you need to know for this course. Don't forget, don't forget to don't forget to like and comment on the video. Whatever thing you need to understand, you can send it as a question to my email diamondforex001@gmail.com. I'll be ready and willing to answer to any questions that you need. And also don't forget my private mentorship class, the one-on-one private session with me. Now, if you're sending me a question, make sure that your question is based on what I taught in class. Anything outside that, I won't respond to it, because this is not a mentorship, a private mentorship class. It's only a private mentorship class that I must attend to all your questions. But when it comes to this, please, you're only sending me questions based on what I thought of or something